probably other investors coming into the same time, right? How much money you're planning to raise, and what are you going to do with that? And what then what is the return, as you said, the return on that investment going to be, right? We think we're going to spend, this, let's say we're raising $2 million. We're going to spend this $2 million on these 6 things. That's going to get us to this point, right? X number of customers, X amount of revenue, this growth trajectory, this kind of burn rate, and, in early stage investing, those type of financial.
Yo, this is Christian D. Evans with Journey with Christian D. Evans podcast. Guys, thank you so much for tuning in and listening to our amazing podcast. This is where we reveal the top 1% of business concepts and systems and processes to scale 8 and 9-figure businesses. We interview top-level 8 and 9-figure CEOs, business owners, and amazing TEDx speakers like David Meltzer. We got Nick Cavuto, Pascal Bachman, and so many others. And if you feel like this resonates with you, please share this with your friend, your family, and make sure you impact them as well, because we're trying to spread the message on those that do not know how to scale 8, 9-figure businesses and talking higher level business concepts. So guys, remember, enjoy the episode and be uncommon if you can. Cheers. Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. Now, this next guest is a high caliber investor that's been in the industry for 20 plus years in the technology world. They've seen the ups, the downs, the sideways, the craziness, the all around. And the reason why I wanted to have him on is because he is actually the CEO and founder of Eppes Venture, which is an incredible portfolio company that has Ask the Internet, HaulHub, National Semiconductor, Sycamore Networks, and Tintri. There are so many different companies that he has. Now, his strategy is actually very unorthodox. Most investors have more of a spray and pray mindset where they go out there, write all checks, a lot of different things, and pray to God that hopefully one of them will produce and develop and create. Brady actually does a very active kind of investing role and position. Plus, he's more of, hey, you know what? I want to invest in the quality, not the quantity. Please welcome my next guest, like I mentioned, the CEO and founder of Eppes Ventures, my friend, Brady Murray. How you doing today, Brady?
I'm great, Christian. Thank you for having me. I appreciate it.
Man, I'm excited about diving into this because, first of all, right off the bat, I love the way your methodology of, hey, you know what? I'm not going to go out there and write 1,000 bajillion checks to a lot of different companies, that spray and pray kind of mentality. Now, my question though, Brady, is during your journey, why did you pivot away from that mindset where a lot of VC and PE, a lot of companies kind of gravitate toward, versus more of this kind of strategy, which is, hey, you know what? I'm looking for quality and not quantity.
Sure. Christian, I think part of it was really driven by, probably the largest part of it was driven by my own personality. And so, I think there are people who are investors that like to look at a million things at once. But I come from an operations background, right? I worked in technology for 20 years in operating roles. I was doing things like business development. So I was, running sales organizations, building strategic partnerships, running marketing groups, that kind of thing. And so, when I look at, any unique skills I might bring to the table as an investor, they're those things, right? That career I've had. And, on the other hand, my ability to look at 100 companies and write checks and invest in 40 or 50 of them all at once and say, okay, I think these are the best 40 or 50, right? There are people who have done that for their entire career and are going to be better at it than I am. Whereas if you look at, maybe getting a little more hands-on with 1 or 2 startups, advising their CEO as they think about, how do I solve this problem? How do I find product market fit? How do I build a partnership with this larger player in my industry? What new challenges should I be thinking about for the next year? Those are kind of problems I have solved before. And so I feel like I can add value in those areas and maybe provide some differentiation, if you will, from what others do. So it was probably driven mostly by, where I felt like my own skills lay and the way I could be helpful and maybe give myself an advantage over other investors.
Now that makes perfect sense. And let me ask you this, Brady, we can talk a little bit offline about your deal flow and what that looks like. And I thought that was really interesting because one, the technology, field or ecosystem, there's a lot of deal flow, a lot of opportunities. But like you were mentioning, there's, the AI, the artificial intelligence, the crypto, the blockchain, all these fun, kind of cutting edge stuff. But Brady, your strategy, very simple, and I'd love to unpack this a little bit, is where it may not be sexy, deals or deal flow or companies. However, though, they're sustainable, and you all know that they got a proof of concept, they got traction established. So help me understand, kind of what that looks like in regards to your criteria or your methodology when you're kind of interpreting or looking at that deal flow and saying, hey, I want to invest in this XYZ company.
Sure. I think it's a great point, Christian. I think it's, a lesson for all investors to keep in mind is, the world in general, the tech press in particular spends a lot of time on whatever the latest, hottest, sexiest thing is, right? It was Web3 and crypto for a long time. Now maybe seems like it's drifting away from that, more into things like AI and other stuff. And I don't say that in a disparaging way. There are lots of great companies being built in those areas. There are lots of bad companies being built in those areas. And so when I look at my ability with sort of an objective eye to find the best companies, convince them that I'm a useful investor and they should take my check, I have to think realistically that, there are bigger names in terms of angel investors out there. There are folks who write bigger checks than I do. And if I was the hottest startup who had everyone knocking on my door saying, I want to invest in your company, I want to invest in your company, why would I pick money from Brady Murray, right? I wouldn't. Right? It's just not, not what I'm going to do. And so, as I think of trying to be a successful investor, I could, pretend that that isn't true and say, no, I'm going to find the best companies no one else will find. Which might happen or might not. Or I could say, there's some other areas, maybe not the hottest, most sexy, but, big old industries, sometimes, I call them underserved. Some people say unsexy, but places where technology can make a big difference and create a real opportunity for a startup to, build a successful business. And because those areas are a little less crowded, because there are less investors chasing them and less companies chasing them, it feels like a chance for me to actually make some good investments and, potentially, with my expertise and help some of these companies grow and be successful and hopefully, turn a nice financial return without having to compete in the busiest areas.
So when you're looking at a company, are you looking at more pre-revenue kind of base, or are you more looking at a growth kind of in growth stage, and then as well as they got some traction, they got proof of concept, be it pre-seed or Series A? What kind of help me understand what you're looking at, or is it really contextual, depends upon the product or the company that you're looking at in general? Help me understand that.
Yeah, it's a very good question. And one of the things I like about investing on my own, so SwiftSku Ventures is my own creation. It's my own money at work. I have no outside partners, no outside investors, and it gives me a lot of flexibility. So lots of venture firms have a specific stage where they invest, right? Seed and pre-seed, or Series A, B, or we're growth investors. We do later BCE stage type stuff. I don't have those restrictions. I can invest wherever I want. I tend to invest more in the very early stage. I feel like, one, it's where I can be most helpful, right? Smaller teams are more likely to need some advice and help from an investor, as opposed to, if you've got a company with 300 or 500 people, you probably have a lot of smart people already sitting around the table. So I tend to do earlier stage stuff, sometimes pre-seed, sometimes, first money in, just, an entrepreneur and an idea. Sometimes I go a little later, Series A type stuff. And then very rarely I do some late stage stuff as well. If it's something I'm very high conviction on, or maybe know someone very well that's doing it. And the other thing that's nice about, kind of the independence I have is it allows me to invest in multiple rounds. So I will often invest, at the very, very early stage with a company. If I, feel good about their prospects, I can then, follow on with larger checks at later times, which is something I like to do. And then, the other thing I do occasionally is I'll pull together what's called an SPV, which is a special purpose vehicle. Probably a term you're familiar with for the audience in case you haven't. You can think of an SPV as really a venture fund that's raised for one specific deal. So with a typical venture fund, right, you'd go out and raise a big pool of money from investors and invest it across a wide range of companies. With an SPV, I go to my network, folks who might have interest in investing in technology companies, and if I feel very strongly that there's a good opportunity here, I'll say to them, hey, here's the deal I'm investing in. If you're interested, here's the opportunity for you to invest as well. So basically, we set up an LLC to invest in that one company. And so that's again, a thing you're seeing actually probably more and more in the venture industry these days. Even some large funds are doing sidecar deals and SPVs. But as a solo angel investor, it's a nice way for me to occasionally allow other people to participate in what I'm doing.
Nice. So you're looking for more of that pre-seed, right at the beginning, early stage investing. Now, when you're looking at it, I've talked to a lot of investors, and when they're having that criteria, that conversation, it's not so much as about the financials of that company as much as it is about the founders. I'd love to get your perspective. When you're looking at a deal, obviously you need to do your due diligence. So what does that look like for you? What's that checklist? What's that criteria? What's your methodology? If you do have one, what does that look like, Brady?
Sure. I think it's a great question, Christian. And I think there's a few, for me, sort of table stakes type of items that I have to check off first. And then I think you're exactly right that ultimately the most important decision for me comes down to the founder and my feelings about them. The table stake things to check off first would be, some basics around, is this a good industry and a good business to pursue, right? Lots of businesses out there in the world, lots of different opportunities. Frankly, most things I see probably don't pass that first bar of, is this a big enough opportunity, right, is one. So, as an example, say you want to open a restaurant. You're a good cook, you like to open a restaurant. That's great. It could be a great restaurant. If you're a good cook and you know about business, you can open a successful restaurant. Not something I'm probably going to invest in, because as a venture investor, restaurants don't offer that return level that I'm looking for. So, is this a big enough opportunity? Is there a big market here that if this company is successful, they could grab a large part of and create a great financial return? And then, of course, you look at all the basics, does the business model make sense, right? Are we selling something we can actually make money on? Is there a customer out there who wants to buy this thing? What does the competition look like? Do we have some sort of differentiation from that competition, right? Why is this business going to win and the other one's going to fail? So all those are the basic things. And, in my experience, in going through that process with an entrepreneur, getting to know them, learning how they see their market, they're obviously going to know a lot more about whatever market we're discussing than I am, but thinking, seeing how they think about it, how realistic are they about the possibilities, how aware are they or what's else is going on, that sort of thing gives me a feel. And then ultimately, as you said, Christian, in the very early stage, it really is the entrepreneur, the founder, who you are making a bet on. Does this woman or man, give me the feeling that I think they could really make something special here. And so, you go through all those checklist items that are kind of must-haves. And then even if all those pass, the question then becomes, okay, ultimately, when I look at this person, do I feel like they're the type of person who's going to have a chance to be successful? And so that probably becomes the biggest factor.
Gotcha. So when you're looking at these kind of deals for these companies, you're looking at like letters of intent. Hey, what's the traction? What have they gotten thus far? And then also, really emphasizing that founder. Now, I've heard this numerous times, and what I find so interesting about kind of gravitating toward that founder is it's very intuition. It's like the same thing when you're a CEO and you've hired and you've hired really good people and you've hired really bad people, you just get that experience of, you kind of know, you don't know exactly, there's no personality test, there's no like, questions or anything. You just have this feeling and this synergy. So I want to ask you, Brady, is there something that you look for? I would imagine prior experience. Hey, have they exited, companies before? Have they been in this industry for X amount of years? But outside of that, is it just an intuition that you have, Brady, that's like, hey, I got this good feeling about this founder? Or are there other kind of characteristic or attributes that founder should have that say, hey, I know from previous history that this company is gonna go very well?
Sure. It's probably a part intuition, and but a part of it is very sort of measurable along some metrics. So we talked earlier about how I often invest in companies that focus on underserved industries, right? And one common mistake in those industries is you have people coming in from outside the industry trying to introduce a new technology and expecting to go well, right? So I'm coming into the logging industry, right? And it's, I've never worked in logging. I don't really know any loggers, but I can read all about the industry and see how it's done and say, oh, yeah, this is inefficient, that's inefficient, boom. I'm going to invent a whole new process and I'm going to bring it and everyone's going to use it and everyone's going to be much more efficient and do great. In my experience, those type of founders rarely succeed. Doesn't mean it's impossible, but I'd much more likely feel confident in someone who's worked in an industry beforehand, right? So, I worked for a logger for 10 years, or my family worked in the logging industry, or what have you, some connection there. And that it doesn't mean only people from the industry can be successful. You can be successful as an outsider, but again, you'd want to see, and you referenced it, Christian, some track record of success. Even if it's in another industry, then it has to be a related industry, right? And that doesn't mean a first-time founder can't be successful, but it is a much higher bar. And with a first-time founder or a founder who's early, I think it's important then to really dig in on how are you going to get this product to market, right? I mean, you heard the phrase over and over again, we all have product market fit, right? Finding that right product that the market needs. And that's always a challenge for an early stage startup. But another challenge is, even if you have the right product, if you will, if you found that product market fit, convincing people to use it. And doesn't mean, particularly in an early stage startup, you may not have, tens or even hundreds of customers online ready to go, et cetera. But do you have what feels like a feasible plan to get there? And have you, done the homework to understand how you're going to do it? And so those are all, sort of the basic things I think that I go through. But there are others as well. You spend a lot of time judging and trying to make decisions based on personality. Does this person respond quickly to emails? When something challenging pops up, how does this person handle that? Is this person personable? Do they do a good job of selling me on their company? And part of that, I think it's important for a CEO to remember, even as maybe from a more technical background, is a big part of your job as CEO is going to be selling, whatever industry you're in, right? You've got to sell your product or your service, but you've also got to sell investors on your company and on yourself. And so that ability, there crosses over, if you will, right? If you do a good job of selling me on your company, I'm more likely to believe that you're going to do a good job, out in the world selling your product or service and have some success with it. Oh, Christian, I can't hear you.
Apologize. But like I was basically saying is, I really appreciate you unpacking that. That was really, really good information. Now, you take more of an active positioning in your investing role, right? You just write a check and say, hey, go make me money, etc. You take more of an active positioning. Now, when you're writing a check, are there certain criteria or are there certain kind of deployment aspects that you like to see your money being used for. Me, for example, when I'm investing into a certain company, I always enjoy when it's on the marketing or the sales, or maybe even the infrastructure of the company itself. That's, to me, knows that, hey, that's going to create a really good ARR on the back end, or certain metrics that's going to get a nice return for the valuation. I want to get your response, Brady. What do you like to see that money when they raise X amount of dollars in capital? How do you like to see that deployed?
Sure. It probably for me varies a little bit more company to company, just because I tend to invest in such a diverse set of companies, doing different things. And so, I think for me, well, sorry, I guess one of the things you're pointing out, Christian, is you like to see a good plan for how that money is going to be used, and some sense that, yep, we're going to spend it here and it's going to pay itself back there. And that's certainly the exact same test I'm looking for now. Now, sometimes in an earlier stage company, maybe the focus in the early days might be more on, solving an engineering problem, or, doing some product design, or, even maybe in the very, very early days, doing some additional research, or, customer surveying, that sort of thing. And so I don't, I'm not so strict as to say, no, my money must be used for X or Y or Z. But I think what I do want to make sure I have a very good understanding of before I write a check is, what is the plan for my money, and obviously probably other investors coming in at the same time, right? How much money you're planning to raise, and what are you going to do with that? And what is the return, as you said, the return on that investment going to be, right? We think we're going to spend, this, let's say we're raising $2 million. We're going to spend this $2 million on these 6 things. That's going to get us to this point, right? X number of customers, X amount of revenue, this growth trajectory, this kind of burn rate, and, in early stage investing, those type of financial projections and metrics are always a bit of a swag, if you will, a bit of a guess. And I try not to, be too strict in holding people to things. Hey, you said you were going to have 37 customers by the end of Q3. You've only got 32. What's going wrong, right? That doesn't mean you're failing, right? There are always things that go bump in the night and problems that startups face, but at least having an understanding, you said ahead of time, what's the plan for spending the money? And then as we're making progress, what's going on? And, if things are slowing down or we haven't met our certain goals, why is that happening? And how are we going to fix it or address it? I think it's all important for me. And one of the reasons I like to be so hands-on, so I can, one, be aware of what's going on at the company, and 2, be helpful if there are areas where I can lend expertise.
Now, when you're talking about an active investor, you come in, and I'd love for you to unpack kind of what you do for each company, because I know you have a lot of different portfolio companies, and each one of those companies is very contextual in regards to what you do, how you help, what they need. But overall, I'd love for maybe talk about 1 or 2 and help us understand how you're able to come alongside them. They're in this situation, they're facing this phase, that pain, whatever it is, and you're able to kind of streamline the process, whatever that is. Help us understand what you're able to do because you're an active investor.
Sure. Well, it's interesting, Christian. At the top of the podcast, you mentioned, some of the places I worked in the past. So, Ask the Internet was a social networking company I started myself and eventually sold. Tintri was hardware and software doing storage for the cloud and enterprises. Eucalyptus was a software company building some foundational software that allowed you to build a cloud within your own network. And so each one of those roles I had in the past, in an operating in an operating capacity within those companies, I had certain responsibilities, and I learned how to do things, right? As we all do, right? You're in charge of marketing, so you figure out, all right, how do we get the word out about this product? How do we, talk to our engineers, talk to customers, and build the right thing? You're in sales. How do we get the product sold? How do we build a sales team? How do we grow, get the word out? How do we drive revenue? And so, that sort of operating expertise I have in the past, I feel like I can bring to bear and help companies, as they need it. So I tend to the approach I often take with investors, and particularly with a new investment, is I'll say to the CEO, like, listen, I'd love to be your first call when things are bad, and your last call when things are good, right? If things are all going well, everything's, happening according to plan, we're executing, great. Once a month, once a quarter, shoot me an email, let me know, hey, we're kicking ass, things are great, all good. Where I'd much rather be is, if you have a problem as a CEO, something's not working, it's always helpful, right, to have another set of eyes look at a problem. It's always helpful to, talk to someone else who's, maybe got some experience or seen something like this in the past and get their thoughts. Doesn't mean I'm, going to wave a magic wand and solve whatever problem a startup might have, but I can at least understand and potentially provide some insight. Maybe, maybe I know someone in that industry who could be helpful. Maybe I've seen this type of problem before and can tell you how we solved it at one of my old companies, those sorts of things. And so that's kind of the approach I take. And, so I certainly, while I like to think of myself as an active investor, I don't ever want to be bothered, right? I don't ever want to be, a guy who the CEO says, oh man, I gotta write that email to Brady, he's gonna be bugging me. That's never the kind of role I want to be in. However, if it's oh man, we're trying to form this partnership with this big player in our industry, and I just can't find a way in to talk to him. I wonder if Brady knows anyone there, or maybe he doesn't know anyone there, but maybe maybe one of his startups had a hard time and maybe they figured out a way to get in, and maybe he's got some insight. So that kind of thing I feel like is where I or any investor can be useful. And so that's kind of the approach I try and take.
Yeah, and that's why I appreciate kind of explaining, because I'm honest to hear this a little bit, because see, you have such an immense background and expertise in so many different avenues that it's contextual with whatever that company is facing at that point, can come alongside and be a very active member in helping them overcome that. Now, we've always talked about successes, and everybody loves to talk about successes, but also we have to anticipate that we will certainly produce that will develop for whatever reason. And that could be just all across the board. I want to ask Brady, how do you have an exit to minimize or contain your loss in those circumstances? What do you do? Systems, boundaries, warrants, kind of whatever, to be able to, minimize that loss in those, situations that we don't want to expect, but we anticipate?
Sure. And it's a great question, and it's something I and all investors should think about. Now, the type of investing I do, right, early stage, almost always equity investing, there are limited ways to sort of protect you from downside. It's also as Christian, and as a lot of people do, the economics of venture investing are a little different than other types of investing, right? So if I'm just investing in public market stocks, stocks might go up, they might go down. Hopefully very few of the public market stocks I invest in ever go to zero, right? And the stock may trade down, and the company has some bad quarters, blah, blah, blah. But at the end of the day, I can always sell my shares. And, most companies don't just go out of business one day. On venture investing, it's different, right? You sort of know going in that a lot of these companies are going to fail. I mean, if you look at, the well-quoted statistics, right, at least 9 out of every 10 early stage startups don't succeed. And so you have to know, as a venture investor, now I'm not hoping that 9 out of the 10 companies I invest in go out of business, but I'm aware that's certainly possible. And so, there are things you can do as a venture investor to try and protect you on, protect your downside. There's things like liquidation preferences you can do, or, anti-dilution provisions and those sorts of things. And I've occasionally done deals with those. It's not where I like to spend most of my time, frankly. My thinking is, as opposed to fighting over table scraps that are going to occur when things go wrong, I'd rather try and make sure I have potential on the upside when things go right. And I know, as an early stage investor, that some of these deals are not going to work. And certainly when a company's struggling, that's where I spend a lot of time trying to help them, whether that means maybe find an acquisition that might not be the glamorous billion-dollar exit we were hoping for, but maybe it's a way to, salvage what the company's invested in, save some jobs for the people who are working there, and maybe as investors we get all our money back or some of our money back, which is certainly better than zero. So we spend a lot of time on those situations. As I sort of alluded to earlier, sometimes when things are going great, there's no need for me or any other investor to get involved. Just sit back and enjoy the ride, which is great. But when things are going bad and the company's struggling, I try and be as helpful as I can and try and mitigate my losses by finding good or creative outcomes that are maybe better than just we shut the doors and fired everybody.
Well, I really appreciate you being authentic and sharing this, because it's a topic we don't discuss that often. We don't talk about. I understand when I'm talking to a VC, they anticipate that, okay, majority of these are not going to produce anything. Will outweigh all of our losses, and that's our anticipation. That's what kind of our expectation as well. However, though, I'm always intrigued to see, okay, what does that thought process look like in regards to, hey, how do we mitigate the loss, right? Because there is, you mentioned as well, Brady, if we spend so much time and energy trying to mitigate a loss, when we could spend a majority of our time and energy on producing the bigger wins, what does that look like, right? It's kind of give and pull a little bit. And because we've also been told, hey, never give up, never quit, right? Never surrender. And those things that sometimes you have to quit, and maybe just quit that strategy. That company is not working. We've tried to raise X amount of dollars and numerous things, and it's just not producing. That's fine. And you have to, like you mentioned, kind of mitigate that. So what are those tough conversations, Brady, that you have? Maybe, because obviously I would imagine you have to be in that. You've been in those situations after 20 plus years in the investor world, where, hey, you realize, okay, I could spend my time helping these people, not teachable, they're not coachable, it's not going to produce anything. Or you could spend your time with this other company that is a holding company. It's one of your portfolio companies. And like, hey, things are rocking, they got traction, they're kicking butt, and we can scale this, and that can mitigate that, or that could kind of offset that loss over here. So just help me understand your perspective and that conversation, that dialogue, Brady.
Sure. I think whatever type of investing you are doing, learning to control the downside as much as possible is really key, and that often means, as you alluded to, Christian, cutting your losses. I don't mean that in a harsh way of, well, this company's not going to make it, I'm just going to write it off, not spend any time there. But at the same time, I think we're all emotional people, right? We all become invested in the things we spend time on. And it's hard to remain objective and realistic about things sometimes. One of the dirty secrets, frankly, of the venture industry is companies are doing well, don't need investors, right? They occasionally need money, but in terms of the expertise that venture guys can, like myself, can provide, it can be useful. But lots of companies, the most successful companies, it's not because, XYZ venture investor made a great introduction and that changed the world for me, right? It's because they had a great product and a great team and they worked really hard and they succeeded. Now, on the downside, that's where, as we were talking about earlier, you can spend most of your time. And I think that's where it's important to be judicious with your time, right? It's an old cliche, but it's the only thing you can never get back. And so, if you're spending 90% of your time with a company that's never going to make it, that's probably a bad investment. It's probably the worst investment you can make. And so being realistic about that company and saying, okay, when we made this investment, we thought it was a good idea. We had faith. We all worked hard. It hasn't worked. Now it's time to move on. And that can be a hard thing. And again, I tend to have a personal relationship with the companies and the founders I invest in. So I don't like to, disappear on them and just stop returning phone calls. You hear those stories. I want to make sure I'm never accused of that. But at the same time, I also want people to be realistic because, as an entrepreneur, you only have one life to live. And so if you're, spending your time just digging a deeper hole that you're never going to be able to get out of, it's important to at some point say, hey, nope, this isn't working. I hoped it worked. I poured my heart and my soul into this, but it's not going to go forward, and figure out something else, right? And so helping entrepreneurs come to that unfortunate realization is sometimes a part of my job as well, and one where you try and be very sensitive and understanding, but at the same time realistic, and letting people know that hey, for whatever reason, this isn't going to work, and so let's find something else. And it's a challenge, but I think you try and do it with humanity and realize that it's part of the job as well.
Yeah, Brady, this is such a needed conversation. I appreciate that, because even though we're saying some stuff that's needed to be said, it's all perspective, and it's all having that tough conversation. And that's what leaders do. That's what really true investors and CEOs, having those tough conversations when the toughest times. But also, if you guys are able to have those tough conversations and actually get through it, you build something so miraculous and beautiful. Now, Brady, on the positive side, exit. I know there's tons of different exit strategies. Love your perspective, Brady. I know it's very contextual, depending upon obviously the company, the offer, where it's at in the growth stage, et cetera, and what offer. But I would love to ask, is there one exit strategy that you prefer than the other? Is it more of M&A kind of side of things, or is it more of an IPO, or what does that look like for yourself? And if it's more contextual, help me understand what goes into M&A, strategy as exit versus IPO exit.
Sure. I think the most important thing that I've learned is that as an investor, you certainly have your preferences, right, for each company, right? I think this company's got a long way to run. I don't think they should sell now, right? I think they should keep going. Or maybe, we've had a pretty good run here, and there's some clouds on the horizon. Maybe it makes sense to kind of get out. Or here's this big player. Boy, if we were part of their company, that would really provide the additional growth and chance to really explode. And so you always have those thoughts in mind of this is what I think is best for this company. But I often think the most important thing is actually to try and understand what the CEO is thinking and feeling, and the leadership team as a whole. But there are folks who can't imagine doing anything else, right? They live it, they die it, and for them, even if the what seems like the right exit might be an M&A transaction, are they really going to be happy with that? And are they going to look back a year or two from now and go, man, my investors really pushed me to sell this company, and now I'm stuck. I'm a VP within some huge company, and my job's not the same, and I'm just not happy. And that's not the only consideration, but I think it's a factor that gets overlooked. Is sometimes an investor, we kind of only think through our own eyes, and similarly on the other way, right? There are times, I think, and this is probably where it comes up, frankly, more, where as an investor you go, wow, this company is killing it. They have got a long way to run. We're just going to keep growing, kicking ass, and we are going to make billions. And there are times when the CEO or the management team in general kind of goes, no, we're not ready for 5 more years, right? We've already put a lot into this, and for us to keep going it alone, that feels like more of a challenge. And sure, that IPO seems like it's a year or two away, but maybe not. And and so I think particularly in those cases, it's really important to say, okay, not the CEO or the founding team has lost the fire or necessarily that, but maybe it's what feels right for them. And even if you as an investor are thinking, oh no, keep going, keep the hammer down, we're gonna, a year from now we'll be worth even more. ultimately as an investor, right, at best, you're a coach. You're probably mostly a spectator, but you're certainly not on the field playing the game. And so, if the players are tired, if they feel like they've given it their all, I think you need to really listen to that. So that's my sense.
It's so interesting because I remember when I was trading stocks and earlier on, and I remember you had to have a strategy to know when to pull your money out, right? Because obviously everybody loves that huge explosive boom. Oh man, wonderful. And there were numerous times where I didn't have that discipline. I learned very quickly. It shot up $4, $5, $7, $10, and I was like, hey, it's just going to keep going up. And then all of a sudden, I learned my lesson when all of a sudden that sucker went all the way down and it dropped very quickly, and I was actually in the negative. And so it's one of those things, Brady, and I appreciate you explaining that, because it is, acknowledging, hey, you know what? So I started, just a side note, I started taking 80%. It went up $3, $4. I took 80% out, and then let the 20% run, whether it went up or down, and then I would mitigate that loss. And so that was consistent regardless, because I knew that, hey, I'm going to allocate my wins whenever I can. So Brady, I appreciate you explaining that a little bit. I want to talk about, there's so many deal flow that's obviously going across your desk. You're an investor, so there are a ton of people that say, "Hey, Brady, give me some money, give me some money." And so I want to ask, what is one strategy that you like to be approached when there's someone, a founder, a CEO, they're reaching out to you and saying, "Hey, I'd love for you to invest." What's that conversation look like? How do you like to be approached as an investor? Because you see it as more of as a synergistic collaboration and relationship long-term with that company. And so I want to make sure for those that are listening, maybe looking to raise capital at some point for their own business, making sure that they have that right approach and that proper perspective in regards to having those conversations with you, Brady. What does that look like for you?
Sure. I'll say the first thing, which is probably known certainly to you and maybe to some of the folks in the audience, but there's nothing better than a warm introduction. And so I would say the majority of the deals I've ever invested in have been people either I know directly, or someone I know directly reaches out to me and says, "Hey, this is worthwhile taking a look at." Someone I know and trust tells me that. And, on the one hand, that's tough advice to hear as an entrepreneur, maybe particularly someone who doesn't come from a world of startups and technology, right? Someone who's not based in Silicon Valley, maybe lives in another country, maybe, didn't grow up wealthy and doesn't know a bunch of people who do investing, right? That makes it all the much more challenging. But I think it's important to be realistic about, how the world works, and doesn't mean you can't succeed if you're not coming from those areas. But it does make it more challenging, and it's also a system you can use to your advantage. And so, as an entrepreneur, if I'm looking to get to Brady Murray or Christian Evans, whoever it might be, to raise an investment, I'm sure I can send them a cold email or find them on LinkedIn or what have you. But people like me get a bunch of cold emails and a bunch of LinkedIn requests. Whereas if you can find a way to get to someone who knows me and have that person say, "Hey, I met this person. They got an interesting startup idea. You ought to talk to her." Or, "Here's a guy I used to work with, and he's a pretty smart guy. You ought to talk to him." That's far more likely to, raise above the level of, the huge inbound flow I get from everyone. So that hopefully is somewhat helpful. I mean, the other thing I would say in terms of, a cold pitch, somebody hitting me up with an email or what have you out of the blue, I would say there's some real basic rules, I think, that are, heavily influence your chances of kind of rising above the rest and kind of making to the top of the pile and at least getting read. Your outreach can't be too long. I think you should, immediately tell me what you're doing, right? So, lots of times I get a cold outreach from someone and they're like, "Hey, love to talk to you. Can we set aside 30 minutes to chat?" Well, who are you and why, right? I mean, I'm busy. You're probably busy too, right? I don't, often just take 30 minutes to sit down and talk to someone without any reason why, right? So, here's my name, right? I'm Christian. Here's my background, right? I know this area. Here's my company. Here's what we're doing. Here's why we're different. Here's how we're going to win. And then if you've got any kind of growth metrics, right, we're growing, 500%, quarter over quarter, or, we have 3,000 signups in the last, 2 weeks, or whatever it might be, right? And that's I don't know what I just reeled off, but, it's 5 or 6 bullet points. It's certainly not a full page email. And I look at that and I immediately go, all right, this is Christian. Here's what he's doing. Here's why here's why he knows what he's doing. Here's how he's doing. I've got all the relevant details. And by the way, that still doesn't mean we're going to have a conversation, because, you might be, hey, I'm Christian. I'm, doing some really cool thing in, Web3 NFTs. Great. Might be a great company. I don't invest in that stuff. So I'll say thanks, but no thanks. But at least neither one of us has wasted our time, right? Whereas if you sent me the 30-minute email and we actually set up the meeting and sat down, within the first minute, you'd say, okay, thanks for having coffee with me. Let's talk. And within a minute, I'd go, well, this is a waste of your time and mine, because I'm not going to invest, and you could be talking to someone who might be. So, I think the mistakes I see are kind of the general outreach, where you're not telling me why you want to contact me and what you're doing. And then also, the overly long one, right? It's 4 pages listing, here's my 3 co-founders and where they went to high school. And this guy was the, captain of the JV volleyball team, like, again, irrelevant details. Someday, if I'm going to invest, this might all be interesting to me, but I'm trying to make a very quick decision as I go through hundreds of emails a day. Is this one worth following up on? And, if it's 3 pages, the odds of me reading through those 3 pages is pretty low. So.
It sounds like you've gotten all sorts of email traffic on that, all sorts of things, from the very, 30 minutes, let's just jump on a phone call, to this elongated, book. It's like, okay, guys, I don't need all this information. So I appreciate you talking about that, because at the end of the day, it is coming down to relationships. But one of the best and the most effective is through warm intros. Having a conversation, you're leveraging someone else's credibility and their kind of ecosystem, and saying, hey, you know what, Brady, you should connect up with James. James, you guys should have a cool synergistic relationship, cool deal flow. Cool. That's awesome. Brady, I really appreciate you being on, just talking about obviously the ups and downs, the way you obviously come into a company and helping them really scale and hitting those growth stages, but also helping me understand your criteria, what that looks like. And then also, when to fold, and when to, obviously mitigate that loss and pull away and focus on those bigger wins. Really love this conversation, Brady. If some of my audience wants to reach out to you, maybe have that conversation, maybe that dialogue, maybe other investors that want to connect and network with you, how do they reach out to you, bud?
Yeah, email is probably the best way. It's just Brady@eppescreek.com. It's Brady at Eppes, EPPESCREEK.com. Probably email is the best way to get me.
Awesome. Hey guys, those links will be in the description below. His email, I'll put that right there, so you can literally just email him real quick. And then Brady, always love to ask my guests, is there any last words of wisdom they'd like to share with our audience?
I should have something very, very smart to say here, but I don't. No, Christian, I really appreciate it. I think, I guess the general advice I would have for people is, I think sticking with, and people always say follow your passion, which I'm not sure that's the best advice I've ever heard. But I would say do things that as an investor, one real red flag for me is somebody trying to start a company in an area they know nothing about. I worked in, whatever it is, right? I worked in software development for 10 years. Now I've got a new idea for a software development tool I think people really need. Wow, that sounds intriguing. You know what you're talking about. But, hey, I read a bunch of articles about how the metaverse is going to be big, so I'm starting a metaverse company. I mean, it doesn't mean you're going to fail, but the odds of you succeeding are just far less. So, that thing you've done in the past may not be, your passion, quote unquote, but at least, coming from an area where you have some expertise and some unique insight and knowledge you can bring, I think is far more likely to drive success. So hopefully that's all.
That's a lot of good wisdom, man. And guys, that is my friend, the CEO and founder of Eppes Creek Venture, the one and only Brady Murray. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can.
Yo, this is Christian D. Evans, Journey with Christian D. Evans podcast. We thank you so much for listening to this amazing episode. If you feel and you know that this was valuable to you, please show some love to our amazing guest by liking this, by commenting on this, by making sure that you do a nice 5-star review and just show some love to our guest. That'd be really awesome. Also, make sure you share this with a friend, a family, a colleague, someone that you believe would bring value to their life right now. And guys, we just want to say thank you again for just being part of our community. If you want to have more resources, don't be afraid. Go to christiandevans.com. You can actually schedule a phone call with me, or you can send me an email at christian.evans@beUncommonIfYouCan.com. That's christian.evans@beUncommonIfYouCan.com. Always love to hear some feedback and let me know what is the number 1 or 2 things that you are struggling in your business and your life, and we'll make sure we have those conversations. Guys, that is Journey with Christian D. Evans podcast, and until next time, remember, be uncommon if you can. Cheers.